Losses are inevitable. Every trader, without exception, will experience losses. It doesn't matter how smart you are, how disciplined you think you are, or how long you've been in the markets. Losses are not a possibility, they are a certainty. The moment you decide to trade, you accept one unavoidable truth. Losing trades are part of the journey. Not as a punishment, not as a sign of failure, but as a built-in cost of participation. Many traders fail not because they lose, but because they believe they shouldn't. They chase the myth of the perfect strategy, a system that never loses, never draws down, and never makes mistakes. This illusion keeps traders jumping from strategy to strategy, indicator to indicator, mentor to mentor, hoping that the next one will finally remove losses from the equation. But markets don't work that way. Losses are not errors in the system. They are the system. The professional mindset reframes losses as tuition fees. You are paying the market for information, experience, and feedback. Every loss buys you data, if you're willing to read it. Emotionally, losses hit hard. They trigger fear, anger, self-doubt, and often revenge trading. One loss turns into two. Two turn into five, and suddenly it's not the strategy that's failing, it's the emotional reaction to losing. So here's the critical shift. Losses are data. They are not your identity. Imagine two traders. The first trader takes a loss and collapses mentally. He questions himself, abandons his plan, and tries to win the money back immediately. The second trader takes the same loss, closes the chart, logs the trade, and asks a single question. What did this trade teach me? Same loss, two completely different futures. Step 1. Detach emotion from losses. To learn from losses, you must first detach emotion from them. When you lose money, your brain doesn't react rationally, it reacts biologically. Stress hormones spike, narrowing your focus and reducing your ability to think clearly. This is why emotional trading feels urgent, impulsive, and irrational. Fear tells you to exit too early. Greed tells you to hold too long. Revenge tells you to trade bigger and faster. Emotions hijack discipline. Detachment starts before the trade, not after the loss. One powerful technique is controlled breathing and mindfulness. A calm nervous system leads to better decisions. Slowing your breath slows your reactions. Another key factor is risk sizing. If a single loss feels emotionally devastating, your position size is too large. Proper risk makes losses survivable, mentally and financially. Pre-trade checklists are another powerful tool. Before entering any trade, ask, is this my setup? Is risk defined? Is this trade planned or emotional? Consider a trader who used to spiral after every loss. By reducing risk and following a strict checklist, losses stopped feeling personal. They became routine, neutral, expected. And that's the key takeaway. Losses are neutral events until emotions distort them. Step 2. Journal and analyze every loss. If detachment is the foundation, journaling is the microscope. Trading journals are one of the most underrated tools in trading because they force honesty. You can't hide from your behavior when it's written down. Every loss should be recorded with clarity. Entry, exit, reason for the trade, emotional state, outcome. Over time, patterns emerge. Late entries, oversized risk, ignoring rules after a win or loss, trading out of boredom or frustration. A single loss means nothing. A pattern of losses tells a story. For example, a journal entry might reveal that most losses happen after 2 consecutive wins, the classic overconfidence trap. Another might show losses increasing during certain hours or market conditions. This is how raw data turns into insight. The key takeaway here is simple. Every loss is feedback, but only if it's documented. Step 3. Extract and apply the lesson. Not all losses mean the same thing. Some losses reveal flaws in the strategy. Others reveal flaws in execution. Your job is to separate the two. Was the setup valid but the trade lost anyway? That's probability, not failure. Did you break a rule, chase price, or ignore risk? That's an execution error.
One of the biggest mistakes traders make is trying to fix everything after a single loss. They add rules, change time frames, and complicate their system. This leads to paralysis. Real improvement comes from small, focused adjustments applied consistently. One trader discovered through journaling that most losses came after trading too many setups. By simplifying and focusing on only the highest quality trades, drawdowns dramatically decreased. Discipline is built through repetition, not perfection. And the key takeaway: lessons only matter if they are applied again and again. Step 4. Build long-term resilience and confidence. Losses are not obstacles to mastery, they are the path to it. Professionals don't fear losses, they expect them, they budget for them, they respect them. Long-term survival in trading depends on risk management, emotional control, and consistency over prediction. Simplicity is what keeps traders alive. Complex systems collapse under pressure. Simple rules endure. Confidence is not built from winning trades, it's built from knowing you can survive losing ones. Every loss survived strengthens resilience. Every lesson applied builds confidence. Losses are not the end of the journey. They are the beginning of growth. Simplify your process, journal every trade, extract the lesson, and apply it consistently. And above all, survive. If this video changed the way you see losses, subscribe now and comment below. What lesson did your last loss teach you?